Who's the most knowledgeable investors on the planet who know the playbook? The central banks. They've been buying for 4 straight years using the suppression of the paper market that we create to support the illusion of strength of bond market and currency to de-dollarize, de-treasurize, and buy as much in the way of commodities as they possibly can. What was gold reclassified as in 2019? Oh yeah, the world's only other tier 1 asset. How'd that 60-40 split work a year ago? It was the worst ever in its history of the 60-40 split, where, stocks, 60% stocks, 40% bonds, the worst ever. And as rates continue to rise, it will get even worse. And that's, you say 40 years, go back to 1982 and look at a chart of interest rates. It's a ski hole straight down. Anyone will look like a genius when you buy assets that are inversely correlated, their wealth, to a falling of interest rates. Rates go down, they go higher. Your house. What's your house worth at 3% mortgage versus 9 or 10%? What's your bond portfolio worth as rates fall? It's worth more and more and more. So the real suppression in all of this has been of interest rates. It created an illusion of prosperity, turns people's homes into an ATM as the price of your home that you bought. My parents bought the home that I grew up in as a kid in Minneapolis for $75,000, sold it for almost $1 million 35 years later. And so did the house go up or did the dollar go down? And when you talk about looking like a rock star, when you buy assets, both, real estate and securities in a declining 40-year declining interest rate environment, the greatest bull market ever. Yeah. What happens just as bullish as all of these? And you talk about the stocks, look at the Russell 2000. Almost all of them are underwater. That is an indication of the broader economy, not 4 or 5 stocks, including GameStop and Nvidia, which is a South Korean company, and Apple leading the way, and the rest are shitting the bed. I'm sorry for my language. I shouldn't say that, but doing poorly. This is a very bad, ominous situation where a handful of stocks, it's an inverted pyramid. You got a tiny little bit, a matchstick holding up the whole pyramid because there's just a handful of stocks. And what are the most knowledgeable investors doing? Using that misdirection. Look at the shiny objects over there and using it to gobble up all of the world's commodities. And so this is why so few people ever succeed in investing, because they follow the herd. But the knowledgeable investor, the big money, the ones who really get it, they understand this is a world of commodities now, not promises and debt and opaque debt instruments. So yeah, there will be, but by the time that flip happens, the biggest money in the world, the most knowledgeable who write the playbook, like for example, in 2017, when the Bundesbank and all of those Eastern European banks started repatriating their gold after 6 years of gold going down out of nowhere. And then next year, 2018, those groups bought more gold, those banks as a group, than they did in the 60 years previously combined, doubled that amount in 2019 after they all brought their gold home from the Fed and the Bank of England. And then the BIS says, oh, by the way, we've now reclassified gold as the world's only other tier 1 asset. Do you think they were told this is coming? Get your house in order, start buying gold and repatriate? Of course they were. It's a good old boys club. So they know the playbook. And when you see them using this massive amount of Western suppression where contracts are created so many times, hundreds of times over on the same ounce of gold, allowing them to manage its price rise. But that was when no one stood for delivery. Now all of these countries stand for delivery, and it's all changing. I don't think we've even begun to see anything yet as to how this all plays out.
The most intelligent investors know the central bank's playbook. For 4 years, these banks have been buying assets, using paper market suppression to fake bond and currency strength. The real move, de-dollarizing and stockpiling commodities. Remember 2019? Gold was reclassified as a Tier 1 asset, putting it on par with top government bonds. Meanwhile, the classic 60/40ths investment split 60% stocks. 40% bonds had its worst year ever, and rising rates promise more pain. Look back to 1982, interest rates have been on a downhill ski slope. Lower rates made everyone look smart because asset values soared. Think about it. What's your house worth with a 3% mortgage versus 10%? Falling rates inflated values, creating an illusion of prosperity. My parents bought a house for $75,000 and sold it for nearly $1 million 35 years later. Did the house value rise, or did the dollar fall? This 40-year bull market was epic, but the tide's turning. Look at the Russell 2000. Most stocks are underwater, exposing the fragile market propped up by a few big names like GameStop and Nvidia. It's an inverted pyramid, and that's risky. So, what are the smartest investors doing? They're ignoring the hype and buying up commodities. While the herd chases quick returns, these pros know commodities are the future, not empty promises and debt. In 2017, European banks started bringing their gold home, and by 2019, they doubled their gold holdings. They knew something big was coming. The BIS then declared gold a Tier 1 asset. Coincidence? Hardly. These insiders were tipped off. They're using Western market suppression to their advantage, manipulating gold prices through excessive contracts. But now, countries demand actual gold delivery, and the game is changing. We haven't even seen the full impact yet.
I don't know how this all plays out, simply to say that I think this system starts to break, and commodities will be realized as asset classes that are far more valuable than the currencies that possess them. But I don't know how that plays out, because people have been enamored with immediate return. They're ignoring the price of gold, largely because the Western media has painted it in such a negative light. It's an archaic relic from the past. It's no longer needed. It pays no interest. The funny thing is, if you were to, in 1960, make a decision, your parents said, look, Grandpa left us 435 ounces of gold. And ironically, gold's $39 an ounce. That's the price of our house, $17,000. 435 times 39 is real close to 17,000, which was the average price of a house in 1960, according to the Census Bureau. And the decision was made not to spend the gold, to keep it because Grandpa gave it to us and we're going to save it for Gary. So let's put it under the mattress, where it's been earning nothing but dust for the past, 63 years? Take out a mortgage. And so that $17,000 worth of gold, that 435 ounces, well, what's that worth today? That 435 ounces today is worth over $1 million. And that's an asset that's earned no interest. And how about the value of the house at $17,000? Well, the average price of a house now is about $400,000, according to the 2024 Census Bureau. Buys you 2.5 houses. What gold does is it keeps pace with inflation. Gold doesn't go higher. The currency that we value it against goes further down, falls with inflation every single year. When my father graduated college in 1964, he dreamed of getting a job that paid $10,000 a year. The first Corvette Stingray he bought in '73 was $6,000. Now it's $130,000. So when you talk about gold not keeping pace because it doesn't pay a return, it's a bunch of nonsense. Since 2000, it's outpaced every single asset class but Bitcoin, including the S&P, even with reinvestment of dividends. It was $252 back then. Now it's almost 2,400. You tell me. I would say that it is the realization that gold is the anchor to a system that will preserve your capital and can actually retain and accentuate your purchasing power. This is not lost on the central banks, but it is on the investing public.
Andy Schectman suggests that he doesn't know exactly how this will play out, but he believes the system is starting to break, and commodities will soon be recognized as more valuable than the currencies that hold them. He notes that people are too focused on immediate returns, ignoring gold because Western media paints it as outdated and interest-free. He illustrates this with a story. If your parents in 1960 had kept the 435 ounces of gold Grandpa left them instead of buying a house, that gold, then worth $39 an ounce, would have matched the average house price of $177,000. Today, those 435 ounces would be worth over $1 million, while the house would be about $400,000. Schectman explains that gold keeps pace with inflation because the currency we value it against keeps falling. He also mentions that his father graduated in 1964, dreaming of a $10 in a year job. His first Corvette Stingray in 1973 cost $6,000. Now it's $130,000. Despite claims that gold doesn't pay a return, Schectman points out that it's outpaced every asset class, including Bitcoin and the S&P 500, since 2000. Gold was $252 an ounce then. Now it's nearly $2,400. Schectman argues that gold preserves and even enhances purchasing power, a fact not lost on central banks but overlooked by the public. He notes that countries now demand physical gold delivery, changing the market dynamics. He believes the system is starting to break, and soon commodities will be seen as far more valuable than the currencies they're compared against, despite negative media portrayals. He concludes by suggesting that if in 1960 you had chosen gold over a house, today you'd have over $1 million worth of gold, while the house would be worth about $400,000. Gold maintains its value over time as currencies depreciate. According to Schectman, central banks know this, even if the general public doesn't.